On February 26, 2022, something impossible happened in global finance. The United States and its allies froze $300 billion of Russia's foreign exchange reserves overnight. In a split second, half of a sovereign nation's war chest simply vanished from the digital ledger. This wasn't just a sanction. It was an earthquake that shattered the fundamental premise of the US dollar. For decades, the golden rule of central banking was simple. Accumulate US treasuries. They were the ultimate risk-free asset. But 2022 proved that risk-free comes with a massive geopolitical asterisk. Paper money is only yours if the issuer allows you to use it. And the world's central banks took notes. Panic spread through the corridors of power in Beijing, New Delhi, and Riyadh. If the US could freeze the reserves of a nuclear superpower, they could do it to anyone. The search for a sanction-proof asset began. Enter gold. Not the paper contracts traded on Wall Street, but physical, heavy, untraceable bullion stored in sovereign vaults. In 2022, central bank gold purchases absolutely skyrocketed, hitting 1,081 tons, the highest level since 1950. And it wasn't a one-off. In 2023, they bought another 1,037 tons. The buying spree has become structural. Who's buying? Not the West. The People's Bank of China added gold to its reserves for 18 consecutive months, up to early 2024. Poland's central bank governor stated explicitly, gold retains its value even when someone cuts off the global financial system. This is a quiet rebellion, a massive de-risking operation away from fiat currency networks controlled by Washington. But to understand how we got to this tipping point, we must first look at the trap the world walked into, the petrodollar system. To comprehend the current central bank gold rush, we must rewind to August 1971. President Richard Nixon shocked the world by permanently suspending the convertibility of the US dollar into gold. Overnight, the world's reserve currency became pure fiat paper, backed by absolutely nothing physical. Without gold, the dollar needed a new anchor. In 1974, Henry Kissinger brokered a masterful, secret deal. The terms were brilliant. Saudi Arabia would price all its oil exports exclusively in US dollars. In exchange for military protection, they agreed to recycle those massive dollar surpluses into US treasuries. This created permanent, artificial demand. Since every nation needed oil, every nation suddenly needed dollars. This system granted America an exorbitant privilege. They could run massive deficits without crashing their currency. The plumbing for this monopoly was the SWIFT network, clearing trillions in daily transactions globally. For decades, it was purely economic. But gradually, Washington weaponized this monopoly to enforce policy. In 2012, Iranian banks were completely disconnected from SWIFT. Their oil exports plummeted by 1 million barrels daily. But sanctioning a middle power is one thing. Seizing the reserves of a G20 superpower crossed a line. If holding dollars is a national security risk, you stop using them. Major economies began trading oil in local currencies. By 2024, BRICS expanded to include Saudi Arabia, the UAE, and Iran. The petrodollar's foundation was quietly fracturing, but you cannot settle structural trade imbalances with volatile fiat. You need a neutral asset. You need gold. To truly grasp this shift, we must look under the hood of global finance and understand how foreign exchange reserves actually work. A central bank's balance sheet is the ultimate bedrock of a nation. Their assets back the local currency. These assets, called FX reserves, are basically a nation's rainy day fund, used to stabilize currency and pay for imports. But here is the illusion. These reserves are not stacks of cash sitting securely in a domestic vault. In the modern fiat system, sovereign wealth is mostly just digital entries on servers located in New York. They are held primarily in US Treasury bonds. Why? Because it is the deepest, most liquid market on Earth. You can buy or sell $10 billion worth of treasuries in milliseconds with zero friction. Gold, historically, was viewed as a clunky, outdated alternative. It pays no yield and costs money to store. For decades, central bankers preferred paper yield, but the 2022 Sanction Shock proved a fatal flaw in digital fiat. Paper carries counterparty risk. A bond is just a promise to pay. Gold is nobody else's liability. Nobody can default on a physical gold bar. And no foreign government can simply press delete. This realization triggered a massive wave of gold repatriation. Nations demanded their gold back from Western vaults. Even allies like Germany quietly brought home over 50,000 bars from New York, completing the process in 2017. The new mantra in global central banking became identical to the oldest rule in personal investing. If you don't hold it, you don't own it. So who exactly is draining the West vaults? It is not Europe, and it's certainly not Washington. Leading the charge is the People's Bank of China. By mid-2024, their official gold reserves hit a staggering 72.8 million ounces. More importantly, look at what they are selling to buy that gold. Since 2013, China has slashed its U.S. Treasury holdings by over 40%. This is a calculated, strategic pivot. Beijing is actively de-risking its $3 trillion war chest from potential U.S. sanctions. Then there is Turkey. While facing a brutal domestic currency crisis, with inflation peaking above 70% in 2022, the Central Bank of Turkey became the world's largest official sector buyer of gold in several recent quarters. It's a dual-layered accumulation. Both the sovereign state and its citizens are seeking shelter from the collapsing lira. And we cannot ignore India. The Reserve Bank of India has been quietly but aggressively adding to its massive reserves. In a highly symbolic move in early 2024, India repatriated 100 tons of its own gold from the UK back to domestic vaults. Notice a pattern? China, India, Russia. The primary accumulators are the core architects of the BRICS Plus coalition, and those are just the official numbers. Industry insiders suspect that actual shadow accumulation is significantly higher. Central banks are not required to immediately report all purchases to the IMF. Many buy quietly through state-owned entities. The result? For 2 consecutive years, net central bank purchases have smashed through the 1,000-ton barrier. Central banks now account for nearly a quarter of all global annual gold demand, fundamentally altering the market structure. This relentless sovereign bid has put a hard floor under the price of gold, changing the math for everyone else. But geopolitical fear is only half the equation. The other half is cold, hard mathematics. Let's look at the sovereign balance sheet of the United States. The national debt has surpassed $34 trillion. That puts the U.S. debt to GDP ratio above 120%. Historically, ratios this high lead to currency debasement. Even worse, annualized interest payments on that debt recently crossed $1 trillion, officially exceeding the defense budget. When a fiat issuer has too much debt, they don't default, they print the difference. Always. This relentless expansion of the M2 money supply is why the US dollar has lost 98% of its purchasing power since 1913. Gold does not yield interest, but it perfectly preserves purchasing power. 1 ounce bought a fine tailored suit in 1920, and it still buys a fine suit today. Meanwhile, a $20 bill from 1920 barely buys socks now. Why specifically gold and not silver? Look at the gold to silver ratio, currently hovering around 85-1. For central banks managing billions, silver requires too much physical storage space. Gold offers ultimate density of value. But here is the most fascinating mathematical anomaly. Historically, when real interest rates go up, gold goes down. Because gold yields nothing, investors abandon it when bonds pay 5%. But in 2023 and 2024, the rule broke. Real yield spiked, yet gold hit all-time highs. This is the sovereign bid. Central banks are not retail day traders. They are price-insensitive buyers accumulating for national security, not quick profit. When the biggest players in the world ignore the math of yield, the entire financial system resets. So, is this the end of the US dollar? Are we witnessing rapid de-dollarization? Not exactly. The media loves the de-dollarization headline, but the reality of global finance is far more nuanced. According to SWIFT data in 2024, the US dollar still accounts for over 84% of global trade finance. And in global foreign exchange reserves, the dollar's share has only slowly drifted down to roughly 58%. The dollar isn't collapsing tomorrow. What we are seeing is not abandonment, but aggressive structural diversification. Think of the global economy as a massive ship in a storm. The dollar is the ship, but gold is the lifeboat. We are transitioning from a unipolar financial system into a multipolar reality where no single nation holds absolute power. In this fragmented world, we are experiencing a massive global trust deficit between superpowers. When you can no longer trust your counterparties, you must hold outside money, assets that exist outside the banking system. But why not Bitcoin? It's digital outside money. The answer is volatility. Central banks cannot afford massive drawdowns. Bitcoin is a highly volatile risk asset. Gold has the Lindy effect, 5,000 years of proven stability. Gold is the foundational base layer of money. It is the only financial asset that doesn't rely on a politician's promise. Yield no longer matters when the principal is at risk. Sovereign nations prioritize return of capital over return on capital. By hoarding physical bullion, the world's central banks are sending a deafening signal to the rest of the market. They are preparing for a high inflation, high debt, multipolar future. Which brings us to the ultimate question for your own portfolio. For 40 years, the absolute bedrock of retail investing was the classic 60-40 portfolio. You hold 60% in equities for growth and 40% in government bonds for safety and yield. But in 2022, the U.S. bond market suffered its worst year since 1788, dropping a staggering 13%. Stocks and bonds crashed together. The mathematical premise of 60-40 diversification completely failed investors. Why? Because structurally, both assets sit underneath the exact same risk umbrella: fiat currency. When inflation spiked above 8% and the Fed aggressively hiked rates to 5.5%, fiat-denominated assets burned simultaneously. Billionaire Ray Dalio famously warned, "Cash is trash, but equities are riskier." You needed a non-correlated asset. Yet Bank of America data shows retail investor allocation to gold sits at a historic low, under 1%. While central banks de-risked $3 trillion, everyday investors were left holding depreciating fiat assets. But the retail market is finally waking up. In late 2023, Costco began selling bullion. They quickly sold out, reportedly generating up to $200 million a month by early 2024. However, a critical distinction remains for retail: paper gold versus physical gold. ETFs like GLD are convenient, but they reintroduce the exact counterparty risk central banks are desperately escaping. Critics argue gold pays no dividend, but in a high-debt, multipolar world, wealth preservation absolute trumps fiat yield. If sovereign whales are aggressively hoarding the ultimate base layer money, should your portfolio really have zero exposure? We have reached the end game of this financial deep dive. Let's summarize the harsh macro reality. The unstoppable rise of gold is driven by two unshakable pillars: geopolitical fracturing and pure mathematical debt. In this environment, holding physical gold is not a get-rich-quick scheme. It is literally fire insurance. You don't buy fire insurance because you want your house to burn down. You buy it to survive. The architects of the financial system know this. That is why they are accumulating 1,000 tons annually. Historically, the window to accumulate hard assets closes quickly once the broader public wakes up. The global financial order is being redrawn right now. Will your portfolio survive the transition? Let us know in the comments. Do you own physical gold, or are you trusting fiat? If you found this Wall Street level analysis valuable, hit the like button to appease the YouTube algorithm. Subscribe and turn on the notification bell so you never miss our next macroeconomic deep dive. We decode the complex world of global finance so you don't have to. Click the video on screen now to understand the secret mechanism behind the Federal Reserve. Thank you for watching, and see you in the next one. This video is for informational and educational purposes only, not financial advice. All investing carries risk of loss. Do your own research and consult a licensed financial advisor before making decisions.